then come back to realize, oh yeah, I didn't calculate that for this policy for the 6 months, a year that it takes to renovate the home. Oh, I also have a $10,000 policy that I have to cover just in case, right? All right, today we are going to have a little bit of fun because you're tired of hearing me talk just about real estate and our boring industry. And today I thought we'd bring in two of our favorite people, specialists in their industry, talking about insurance and finance. So go ahead, introduce yourselves.
I am Jordan Altenhof with Goosehead Insurance here in Rockledge, Florida.
I am Randy Hiester with Direct Mortgage Loans. I'm a mortgage loan officer.
Awesome. How long, respectively, in your industries or your companies, maybe?
So our office has been open for 7 to 8 years now, since 2017.
I've spent the last 3 years with Direct Mortgage Loans.
Yes, and Caleb, though, has been here for how long?
He's been here. He's in his 8th year now.
8th year. Mm-hmm. Awesome. So today I just wanted to talk about some interesting things, right? Like all of a sudden we have some things changing in the lending world with the announcement from NAR about buyer broker agreements and maybe buyers wrapping that in. And also, for whatever reason in Brevard County, about 25% of the listing appointments that I have gone on recently, they're like, we want out of Florida. Insurance prices are skyrocketing, and so I just wanted to bring you both on and talk about those. Let's kick off with those two topics right off the bat. Who wants to go first?
I want to hear about NAR. It's been the hot topic lately.
Well, I'm not the expert on that. That's coming from the real estate side, but it will impact the lending, obviously.
Right.
Because depending on, does that have to be charged to the to the buyer going forward, or is that going to come out of the seller's commission? Is that fee going to come out of the seller's closing costs, or is that going to be something that's the buyer is going to have to take and be able to work out a deal with the person who's buying and saying, hey, you're going to pay me 2%, 3%, whatever that is?
Yeah. All right, so I'll kick off another question, and then we can just jump right in, right? So what I see happening from NAR. And again, I'm not the expert. I spent a decent amount of time. I'm always like heavy into the research. And I believe there's a day that is coming soon where a buyer will have to wrap their buyer commissions into a loan program, right? Like I've been clear on this, that specifically this is going to hurt first-time home buyers.
Absolutely.
Or that lower entry. VA right now, you can't wrap that in at all. So I think, they've had this 100 days to try and figure it out. I think it's probably going to take a little bit longer than that, but I do see a day coming soon where a buyer is going to have to come to the lender and say, on top of everything else that I'm trying to figure out, I also maybe have to pay my buyer's agent who's worked their butt off for me, right? And so I guess the question is, how do you see the mortgage industry changing, or what have you seen in the last 3 years? Because I think the general public doesn't necessarily see the duck kicking underwater, right? They just see the duck kind of cruising. Yeah, we're getting loans, interest rates are higher, right?
Absolutely.
What's your experience inside the lending world? How quickly does your world change is maybe a better question.
I think that's a great and a loaded question. So right now we're seeing a lot of first-time home buyers or people who want to become first-time home buyers. And we're jumping through hoops to try to take and be able to get these people qualified. Right now, if you think about it, generally closing costs are 3.5% to 4%, depending on what time of year it is. If it's closer to the end of the year, it's closer to 4% because of the fact that you have almost the whole year's taxes you're pulling. Plus, you've got your down payment. If it's 3% on a conventional minimum for first-time home buyers, 3.5% on a FHA loan. So if you take those plus your closing costs, I mean, if it's an FHA, you're at 7% minimum, okay. Right. Plus, if you're going to have to pay 2 or 3% to the buyer, that's going to the buyer's agent. You're going to have you're up at 9 or 10% maybe now. And right now we're having a hard time sometimes getting someone squeezed into a program. We're using things like first-time homebuyer programs. We're using the bond program, the Hometown Heroes program. We also have a 100% FHA program now. that we're using to get them in that, and a lot of times we're using seller assist. When the market gets better, the seller assist, a lot of times, as you know, PJ, that goes away.
Right.
They're not as willing to do that. So to be able to take and add 2 or 3 more % on some of these people that were barely getting in the door into their new home, that could be a challenge going forward.
Yeah, I jumped on this the first weekend that it was out, and I said, here we go, government trying to fix a problem and yet create another problem. And
Yes.
traditionally speaking, it always hits the middle to middle class. Oh, we'll fix this problem, and yet the buyers all of a sudden are going to have to kind of scramble a little bit, right?
Yeah, absolutely. Yeah, that's well put.
Yeah.
Yeah.
I remember, so I was fortunate enough to be grow up in a bank, if you will. My mom was like a teller, and then an LO, and then in charge of a loan department. And I can remember 2008 and 9. The feds would come into the bank and say, "This is the new way we're going to do it," and then they'd come in Friday, literally 4 days later, and say, "Well, forget about what we told you on Monday. This is actually the way we're," And it's not like this just things like feds walking in and making new policy happens overnight, right? Like in the lending world, they're pulling all of the resources in to say, "Oh, great, now the Fed, who controls this, has told us we have to do it X, and 4 days later, now we got to do it Y, and 4 days later, now it's Z," right? Mm-hmm. And so.
So another thing I think is going to happen out of this, PJ, I mean, and time will tell, is the buyer, in order to absolutely be able to qualify, they're going to have to even more rely on seller commission probably, which means some of that money is going to come back from the seller anyhow through closing costs rather than through commission. You know what I mean? Otherwise, they may not be able to qualify for that home, or they'll have to sell it to somebody else for cash, or someone else who doesn't need that assistance.
Right. Yeah. It really sadly affects a lot of people that really need stuff like this, right? Like, I think at the end of the day, buyers were paying for the commission. It was just in the sales price. We just called it something differently, right?
Yeah.
Like a seller was factoring in that they were paying a buyer's commission and a listing agent, right? And all of their closing costs sometimes, right? We'd sit down at the kitchen table, like, show me the net sheet. Okay, I want all of that to go away.
Yep.
Right? And yeah. So, Jordan, what do you see changing in the insurance world?
So we have the benefit now of carriers are coming back. And so for a while there, carriers were only insuring homes 10 years or newer. That was kind of how it was going. They were only insuring roofs 10 years and newer. But they have been able to kind of overcome a lot of the obstacles by allowing for a different type of endorsements. Like there's now a roof schedule endorsement. So instead of only insuring a roof for 10 years, they're saying, hey, we'll insure a roof for 20 or even longer for clay tile or metal, but it's going to have a roof schedule. And that means that you're no longer going to get your 20-year-old roof replaced for its replacement cost. They're going to depreciate that roof and what's paid out by how old it is, which maybe should have been there all along. Like, why should someone with a 20-year-old roof get a brand new roof for free when they got 20 years out of that roof?
Interesting.
So there's been different things put in. So whereas last year we basically had 3 carriers open writing when we were appointed with maybe 20 or 30. Right now we're starting to see more carriers come back, insure homes 40 to 60 years old, open up those roof guidelines. So we're able now to run people through 15 to 20 carriers again. So more options means lower prices. Mm-hmm. As long as we have a good storm season, the prices I think will kind of slowly, like we're now seeing carriers lower than Citizens, which was unheard of a year ago.
Yeah, absolutely.
So I have hope. When people call in, I'm like, just give it a year. Hope we have a good, storm season, and it'll ride itself out. But anything in a capital market, more competition means lower prices.
Yeah,
so,
absolutely.
Yeah.
I think it's needed, right? Like, because we are seeing just what I hear from our clients is insurance has gone through the roof.
It has, and it's
no
hard.
No pun intended. Gone through the roof.
It's hard to get those calls from, especially the older people that are on a limited income, and they can't afford their homes. a lot of people will buy outside their budget, and they'll try and fit into the budget when they're buying their home, and then they'll get that doubled renewal the next year. And then also maybe they bought a home that was owned for 10, 15, 20 years by the last owner, and those taxes will triple at their new, even if it's homestead.
Right.
So then not only do they have a doubled insurance bill, they also have a doubled tax bill. So their mortgage has gone up considerably.
Right.
It is hard to get those calls and explain all that. And, it's not just your insurance. It's also your taxes or escrow accounts, basically over accommodate for what was, taken the year before and what they anticipate the next year. So people think their insurance went up $700 a month, but really they're paying for last year's increase, this year's increase, and the bank expecting next year's increase.
Right.
So it's a lot, and it's hard on people, and it's really crazy. And condos also, the HOA insurance for condos, the actual HOA policy. We had a letter come in the other day that the HOA only anticipated a 30% increase, so that's all that they had in reserves. It went up 240%. So the people were basically given two choices. It was, hey, everybody's HOA can go up $300 a month, or we're going to bill everybody the 1st of April $4,500, and it has to be paid within 10 days. And not a lot of people have $4,500 just sitting around. So it's turning into a little bit of a crisis. But I don't know, we just kind of have to ride it out.
Yeah.
If you want to stay in Florida. It's a great state, but we were not ready for hail. Hail is ultimately the culprit for all this.
The hailstorm.
That's what I was just going to ask. Is that what the
hail
reason was?
Hail in Florida is uncommon. It's unheard of. It's not a thing. And the
Snow in Florida.
Snow.
Hard balls of snow in Florida.
Yeah. So for 2 years in a row, we had nasty hailstorms.
Yeah.
And it not only did it damage roofs, it was damaging siding. It was damaging windows. And people took advantage of that. They really did. And, you pay for insurance. You want to use it because you're paying for it.
Right.
And so I can completely empathize with that. It also tore up the auto industry. A lot of times if a certain percent of the car is damaged by hail, they will just total that car and the person will get a whole new car. So the auto industry, you're going to start to see your auto insurance rates going up a lot. Mine, we have no tickets, stellar credit, no accidents at all. My insurance went up $700 a year. So,
because of hail.
Well, that's part of it. I mean, there's
Right.
a lot of fraud in Florida. There's a
Right.
lot of uninsured drivers, that type of thing. But yes, all those floods from last year, the Central Florida floods in Orlando and whatnot, those cars all flooded, all totaled cars. So those type of things have a long-term effect on those industries.
Yeah.
And
Yeah, we forget hail. Oh, that was
it affects
that was last
home
year.
and
Why is
auto.
that now affecting me this year? Right.
Yep. Yeah.
Catching
and
up.
It does. It'll you'll feel it for 2 or 3 years.
Yeah.
Because of it. So
You mentioned something, and I'm a little unclear of. So if you're having a schedule for your roof, go into a little bit more detail for the average person on that.
So it's a way to save a little bit of money, but it's also a way to open up your options. So when the hailstorms hit, like I said, you were seeing 18, 20, 22-year-old roofs that were at the end of their life. They needed to be replaced, getting replaced, and the carrier was paying out full replacement costs on those roofs, $20,000, $30,000 with a $1,000, because it's your all other peril deductible, hail. So $1,000 deductible, $20,000, $30,000 roof. That roof really should have been replaced by the owner because it was maintenance. That is a roof at the end of its life. It should have just been replaced by the owner, but the hail, because hail does damage to every roof, made it so the carriers were replacing those roofs at the end of their life. So they kind of learned that lesson and said, we're going to now make the roofs insured based off of their age. And so a lot of the carriers have made it so you can endorse or add, an endorsement to the policy that says, based on the age of your roof, every year it gets older, we pay out less on a roof claim. And it's probably going to benefit the insurance industry in the long term because people have started using their home insurance like a home warranty. Every little thing gets paid out, when at some point you have to take responsibility for being a homeowner.
Right.
Your old roof needs to come out of your pocket. Your leaking windows you need to seal. Those types of things are home maintenance. They are not catastrophic loss,
Right.
which is what your insurance company, I have to have this conversation every day, which
Yeah.
is fine. That's my job. But that's what it is. Home insurance is for unexpected catastrophic loss, whereas it's been being used as something completely different.
I'm guilty. I bought a house that I knew in 5 to 7 years needed a new roof, and made it through the first hurricane, and then the second hurricane I went out and I was like, yeah, my neighbor asked, like, I wonder where all these shingles are from. I was like, yeah, that's my roof in your front lawn. And it was at the end of its life, and due to 2 hurricanes kind of close together, we were able.
But
and yet it'll affect think about the homeowner that hasn't saved or hasn't put away that money, thinking like, oh, I'll just wait for the next named storm to get a new roof.
Yeah.
I haven't put away 20, 30. I mean, if you get into tile roofs, it's 6 figures on some of these roofs.
I mean, and that's not your fault. That's not the consumer's fault. That's how the policy was set up.
Right.
So you used the insurance the way the insurance company allowed their policy to be. They are just now curbing that by saying, like, in that scenario, if you did that today, you would get what would be 5 to 6 years of life left payout on your roof.
Right.
Because you got 15 to 16 years out of that roof, so they're not going to replace it at a cost anymore. Now, I will say not all policies have this. Not all carriers are offering it. It's just something that some carriers are offering to open up business to more people.
Do you see it expanding to more carriers?
I think it should. If people don't, a lot of people look at insurance as something they are required to pay for. They don't want to pay for it. They don't plan to use it. But now they're being forced to pay $4,000 and $5,000 for something that they don't even plan to use because other people did use it. So yes, if those type of people want to have that option should be there. Yeah. And it is an option at this point. I'd say there's only 2 carriers that make it required on all policies.
Okay.
But
if you were to look 5 years, 10 years down the line, do you see this with more carriers picking this up as a policy?
It's a possibility. We're going to have to see how it plays out in claims. It's explained to everybody. It's right there on their quote. It's right there on their policy. It says roof schedule endorsement. They get a printout that shows how much they get based off of every year it ages. Right. But we're going to have to see how it plays out in claims. Attention. Right. And how it plays out in the claims experience. I mean, it's pretty black and white.
Yeah. Yeah, I see it as kind of a catch-22. Like, I didn't tuck away some money knowing that I'm going to need a new roof someday. All of a sudden, a named storm hits.
Yeah.
And I need to replace my roof because I do not want water coming into my house and creating more damage. And so now all of a sudden I'm in this emergency situation in a way, right?
Roofing companies may have to, they may have to accommodate that. They may have to start making finance plans and stuff like that. I mean, they made out like bandits the last couple of years. Right. Big time.
Yeah, I don't see why that's necessarily a bad thing for a roofing company, right? Like, we'll let you pay it off for the next 5 years.
And some people will get like a home equity line to replace the roof or make upgrades. Like, you don't always have to come out of pocket for it. But yes, it can't always fall on the insurance company to maintain the home. Like, at some point, there has to be other options.
I tell this to most insurance people. I saw Chris Rock live in San Francisco, and he, I won't use the exact verbiage that he used because it was a comedy show, and this is not. But he said, insurance should be like, in case stuff happens, but when stuff doesn't happen, shouldn't I get my money back? And everybody in the crowd erupted, and I was like, true, and that's maybe how the general public sees insurance, right? Like,
they do.
My wife loves insurance.
Yeah.
PJ, I'm like, give me what I have to have just in case, and I think I'm probably more like the general public, right? Like,
yeah, I think people like insurance when they need it.
Absolutely.
That's, and I don't blame them. I pay a lot for my family to have health insurance. We don't even go to the doctor. We legitimately don't have primary care. We don't go to the doctor. My kids get sick. We figure it out. But I am paying so much money in health insurance in the event that something truly catastrophic happens to us, I'm not going to let it bankrupt me.
Right.
But boy, are they making a pretty penny off of me, and I don't even use it. So it's like but insurance is a pool, and it's fun explaining that to people. It's like we always get why is my insurance up? I didn't file any claims, and it's like I understand, but insurance is a pool. When so much money goes in, rates come down. When so much money leaves, everybody's rates they can't just be like, because you filed a claim, I'm raising your rate, and because you didn't, I'm going to lower yours. Like, it can't. It has to be. It's based off of zip codes. So, unfortunately, that's just not how it works.
I was instantly thinking of like the Progressive commercials that they berated us with, right? Like good driver discount and stuff like that.
You do get discounts individually, but when it comes to like a rate increase, they have to file with the state. The state has to approve it, and each rate increase is like location based. I think it's zip codes, because someone will move from 32940, and they'll move out to 32937 or something like that. Their rate changes just based off of the zip code. Right. But knowing all the inner workings of insurance and their rates, we don't know actually all of it. A lot of it's insurance scores. We don't know. Each individual carrier has a different way of rating someone's insurance score. They pull different things and rate it all differently. So,
where do you see insurance long term in Florida? Let's just play it out that global warming exists, and we're going to continue to see more and more storms. And what do you see long term in Florida?
I see the homeowner taking on more responsibility in the event of repairing their home. I think insurance companies are going to become a little more hands off. It's going to go back to a truly catastrophic policy. I mean, back in the day, your insurance policy was fire only. Like, your house had to burn down to get an insurance payout. Now it's like, oh, my AC broke, or oh, my water heater leaked. I'm going to file a claim for every little thing. Oh, my fence blew over in the hurricane. I'm going to file a claim. And that's
guilty.
You have to exceed your deductible, and that you want to make sure you far exceed it.
Right. They threw it on with my roof claim, but I was like, I could fix that. And since the adjuster came out and put it on the claim, I'm like, sure.
Yeah, well, it's going to be, in that case, it makes sense because you had a large claim behind it. But I think it's going to become less about that. It's going to become a truly catastrophic policy again, because how are they ever supposed to stay in business and make a profit if they're fixing every little thing?
Yeah.
So that's where I think it's going. It's going to go back to the days where, you have to have considerable damage. And it's already going that way. Like, a lot of people are carrying a 5% hurricane deductible right now. Like, most people don't have $20,000 on hand to pay out before their carrier pays out.
Right. So
you're not going to file that claim because your damage isn't going to exceed the deductible you've chosen. That is then a catastrophic loss policy.
And to clarify, as you increase the percentage of deductible, traditionally the rate
goes down.
Mm-hmm.
Yeah, the higher deductible, the lower the premium.
So save money on the monthly or annual basis, but get ready for catastrophic.
Yeah, and I don't necessarily see anything wrong with that unless you're someone that doesn't have money on hand. If you are someone that's never truly going to use your insurance, unless it's the event of a catastrophic loss, like a huge one, there's nothing wrong with carrying a high deductible. But if you are not someone that has a lot of money on hand to back yourself up in the event of minor things going wrong with your home, you don't want to carry that high deductible. It's just not, it's not safe. You do need your insurance to pay out on things that you can't afford to pay out when there's unexpected loss.
Yeah.
Just be mindful of that. But our agency is very big on what is right for you and your insurance policy and your financial situation in your home is not what's right for me. And I'm going to give you options, and you know what's right for you.
Right.
And that's fair. I mean, everybody has a different situation.
Right.
So.
Okay, can I ask Jordan a question?
Yeah.
So, I have somebody who was putting an offer in last night. Okay, mm-hmm. Now the house that they're looking at has in fact, I gave them Ryan's number yesterday to give him a call to try to get some expertise on this. But they're going to put an offer in on a house that has leaks in 2 spots. It's a clay roof. Mm-hmm. But they want to get a house, they want to get a loan for this house and have it be a conventional renovation loan. And but the issue is, if it's a renovation loan, knowing that post-closing, we're going to be able to, they're going to be, money's going to be in the escrow in order to pay for these expenses. Will you guys insure that house knowing the end result, or is the policy going to be based upon the present result?
So roof leaks are they're almost impossible to get approval. The type of insurance policy you're talking about where they're going to be doing renovations, it's called a builder's risk.
I love this one.
Builder's risk. We do have product for that, but even those carriers have gotten more and more stringent on what's required to qualify. They want 4 points. They want the 4 points to be clear. They know the house is going to be getting remodeled. They understand that. But there's going to be a multitude of things that we're going to have to look at and, send that 4 point over, and it's going to be up to the carrier. Like, you could send over like, hey, they have a roof contract in place, and the carrier would then take that into consideration. So is it going to be a short-term rental? Is it going to be vacant? There's just what kind of renovations are they doing? Are they removing walls? Are they ripping up slab? There's just so many questions we have to ask. So it really is case by case. And with these types of policies, we are having to submit to the carrier for an underwriter to review for approval.
So in that case, they're putting an offer in on a house. You almost need a contingency in your contract that the insurance is going to be offered. In other words, that they'll be approved for the insurance, correct? Because, I mean, if you go and you get that offer, if that was you putting that offer in last night, PJ, and they come back today and say, yeah, we'll accept it, we've already put in there that it's got to be something where the appraised value needs to come back at the purchase price plus the expense for the repairs. Most of it is updating. It's a 1980s type home, so it's a lot of it's going to be bathrooms, kitchens. Right. But this clay tile roof, they may take and remove it and put a whole new roof on.
We do have a product that, and again, we would have to put the address through to see if we could even get a rate. But we do have a product that's now vacant remodel that has no roof coverage and no water coverage. So it is truly a catastrophic policy. And in that event,
in case the contractor burns the house down.
Mm-hmm. And in that event, we would not need underwriting approval. We would just be able to bind that because there is no roof coverage, there is no water coverage. The carrier is just basically like, hey, short of the house burning down, like, you're not getting a payout anyways.
So in that case, it's a matter of we need to get our underwriting to approve allowing that until
that meets mortgage requirements, that particular policy, because it is replacement cost.
Yeah, I mean, I see more and more where our team specifically, like when we're in the inspection period, you are getting an insurance quote and giving that to the lender to make you don't want escrow money going hard post inspection and come back to realize, oh yeah, I didn't calculate that for this policy for the 6 months, a year that it takes to renovate the home. Oh, I also have a $10,000 policy that I have to cover just in case, right? Like, because it sounds like it doesn't meet the normal. It's not something that you just put in a box and say, yeah, we'll just run the address through and you want insurance, right? Like there's several steps.
Yeah, we have to put the address through and see if the carrier, it meets their reinsurance threshold, is what they call it. And if it does, then they give a rate. And if it does not meet their reinsurance, then they don't. And a lot of that is like how much business they have placed in that zip code. And if they have too much, they will not insure it. So it really is a case-by-case basis.
Yeah. Yeah, I mean, more and more, I'm like, whether we're the buy side or the list side, like we need, we're talking to the other side and saying, I need you to do, just because you have a 20-day or 25-day loan commitment, I don't want you to get to day 22 and all of a sudden you're shopping insurance, a week before or 2 weeks before you're moving in the house and oops, now we've been off. If I'm the listing side, I've been off the market for 20 days. It absolutely hurts the seller because the buyer's agent, whoever their insurance, whoever their lender is, like just waited until the last minute.
Yeah. Yeah, I had someone send a client 3 days before closing the other day. It was a cash buy. They were buying a duplex out at the beach, and the house was fine. There was nothing wrong with it. It was just a duplex out at the beach that was frame, and it had the lowest grade roof attachment, which heavily affects the rate, that wind mitigation. And I sent the rates, and they were between 7 and 10,000. And the buyer was beside himself. Like, he's like, I need this lowered by like $2,000. And I was like, that $7,000 quote, it has basically nothing on it. Like, it is a catastrophic policy that's not coming down.
Right.
And I don't know what ended up happening with that deal, but I mean, he should have gotten his quotes much sooner. But now he was locked into this like 3-day close thing.
Right.
Yes, get your insurance rates much sooner than that.
Why not do it in the inspection period?
Yeah,
He didn't
absolutely.
he didn't do an inspection period.
Right.
So,
Well, I mean, for
yeah.
the average person
Yeah.
that's watching, like, average agent, get it done early. Like,
Yeah.
I've seen it blow up so many
Recently
transactions, and it becomes catastrophic when seller has lined up a mover and bought another house, and
that's not good.
yeah.
So speaking of inspection periods, and I bring this up because I just had a buyer who's in the process of securing which home they're going to buy, but had a conversation with the parents of this buyer, a 3-way conversation, and they were saying, well, the 15 days is the window. That's how long you have for a inspection period. I said that may be what's default on the contract, but most of the time I'm saying 3, 5, 10 days. I'm not seeing much past that. What are you seeing?
Oh no, I mean, 5 to 10 days.
Is it
on average? 5 being fast, 10 being about average.
Yeah.
We see 7 to 10 probably realistically, and inspectors can now get out in 2 to 3 days, right?
Yeah.
Like, yes, there was a time where we were like, yeah, we have to put 12 or 13, depending on if it's a weekend, and you as an agent, you have to look at a calendar and say, great, it's a 10-day inspection period, but I lose Saturday and Sunday and Saturday and Sunday, so now I have a 5-day window, and inspections are worth their weight in gold.
Yeah.
So you have to have it for insurance. You should always, right? Like, it's amazing to me how many people are still out there like, yeah, I don't need an inspection. The house is 2 years old. I'm like,
Yeah.
could be something in there still.
something I do want to go back to, because I've worked in new construction a long time, and builder's risk, right? How the insurance company called this policy builder's risk, because here's what I hear from every single client. Well, why do I need to carry insurance for my builder?
So I'm actually not a good person to talk to about that. The builder's risks we do are on the older homes.
Okay.
So our office, we probably have a product for the ones where the homes are being like built from the ground up.
Yeah.
But it's just not our expertise.
Not your cup of tea.
Yeah, no.
I've seen those rates quadruple as well. But
I know. We have a Texas agent that's like, why aren't you guys writing these policies? And we're just big believers in like doing what we know, and like maybe we'll do it once we learn it and understand it. But until I really get what I'm insuring and I understand it, we just don't offer the product yet.
Yeah, it's a goofy name because it's really the homeowner's insurance while the home is being built or going through a remodel.
Mm-hmm.
But because it's named builder's risk, it's like, well, that's not my responsibility. That should be on their responsibility, right? And then it does. I don't know very much about the policies, but I know appliances can be, disappear in the middle of the night, and builder's risk didn't cover the appliances disappearing in the middle of the night. And so then the builder's like pointing at the owner's policy and their policy. Like,
That sounds like a nightmare.
it was not fun.
No, that definitely doesn't. It's not so fun at all. I have not seen that. We had a client the other day that was buying a home, and their moving truck got stolen while they were staying in the hotel moving down here. So they had to file a claim on that home they were selling's home insurance on this products, the stuff they were bringing down from their old home. So now they have an open claim in their history. And so we're trying to bind insurance on their new home, but they have an open claim on their old home. It turned into a whole thing. So yeah, they had their moving truck stolen.
That is, I don't wish that upon anybody.
No, it was awful.
Yeah.
They were trying so hard to work their way around it, but it was like completely out of their hands. Luckily, we were able to figure it out for them. But
Just to clarify, was this like a U-Haul or?
Yeah.
Okay.
yeah,
Because I was going to say, if a mover actually put that on the homeowner, it would be very
It was a
interesting.
U-Haul. Yeah, no, they were parked in the hotel parking lot. And then you wonder, like, does U-Haul take some responsibility there? Because, like, why was their truck so easy to start and steal and open? You know what I mean?
Right.
Yeah, I don't know. That stuff I'm just...
Yeah, that's one of those things like, would you like the insurance? No, I don't want the $7 insurance when I rent the U-Haul.
Per minute.
Let that
I
be
wish
a
I
lesson.
actually had.
Oh, my gosh. Nope. Yeah, that was a crazy story.
So, Randy, where do you see in your crystal ball inside of your office, what do you see going on with interest rates? In the next 12 to 18 months, the big question always.
Well, our crystal ball is based on the feds.
Mm-hmm.
And based upon what the feds tell us, they keep pushing it down the road. And, I mean, they initially said 3 times this year they'd be lowering the rates, which obviously would help us out. But that hasn't happened yet, and they keep pushing it. It's no longer May. It seems to be a little bit further down the road. So that's an impossible thing to be able to take and be able to guess what's going to happen. I can say this, that they're down about 1.5% from what they were maybe 4 or 5 months ago. I mean, it is better than it was. And that's the reason why we're offering things like a 2-year no lender fee refi with every purchase. We've been doing that since about August of 22. We're offering that so that I tell people, get the house you want now, get the rate you want later. You know, people say, well, you know, there's not as much inventory. Well, that's a true statement. I mean, you know that the inventory isn't like it was a couple of years ago. But if you have more inventory and the rates are lower, back then what was going on is I went to one open house, for example, on a Saturday, and there were 80 people that had gone through that open house. Yeah. And 30 offers were made on that home that weekend. Well, you're competing. And so although there might be a higher inventory, you know, there might be more and better houses out there, you were competing against people who were bidding $20,000, $30,000, $40,000 over asking price.
Oh, yeah.
And so you weren't any better off. Get the house you want now, get the rate you want later, because that's going to be for the rest of your life. I mean, if you wait until, you know, the inventory's better and the rates are better.
Inventory is good right now. We have, our inventory has ballooned and people have options.
Yeah,
like it is very, I mean, I don't know where it sits today. I'm not going to quote a number and actually timestamp this, but right, there are over 3,000 options inside of Brevard County, and I
is that categorized in a certain like the 250 to 400, 400
nope,
to
all the way open
across the board?
We have 3.5 months of inventory right now, right? Yeah. Where you know, I have good friends all over the country, and so you know, I'm a data nerd. And I'm like, show me your inventory, right? And it's like 300 homes came on the market, 300 homes came off the market, right? Mm-hmm. We have a 1 month supply of inventory, 3.5 months as we sit, right? Like somewhere in between the first and second quarter in Brevard County, people have options.
That's much better than it was a few months ago.
Yeah. Yeah.
I mean, a few months ago, I had a realtor tell me that there was only about 500 homes or something like that on the market at the time.
Yeah, maybe in a specific price point or something like that.
So, I mean, if you get the house you want now, you can refinance it later at a better rate, and that's going to be good for the duration of, you know, of your loan. Whereas if you wait for you know, a new you know, the right house, the right time, the right price range, the right interest rate, all those things will line up. You're going to pay more for that same house.
Yeah. Yeah. I am not a huge, it was funny, I'm not a huge Dave Ramsey follower. And yet I was talking to a friend and who also I know is not a huge Dave Ramsey. And over the weekend, he dropped a video that was like, this will be the lowest you see home prices in the next 5 years. And you know, I took some time, thought about it, actually talked it over with a friend, and I was like, right, like, Dave's usually, like, he's built an empire on being correct around the market, right? And so though I'm not a big fan of his, you know, when interest rates come down, all of a sudden there will be this massive movement inside the market. And, yeah, I mean, buy now. Here's what I always tell people, right? Because there was the buy the house, date the rate, and all this sort of stuff, right? Like, if you can afford the house today, buy the house. And when rates do come down, because they will come down, the time frame in which they come down, nobody has that crystal ball, right?
Yeah.
But like, there is no doubt that if you buy a home for $500,000 today, when that home goes to $550,000, you are going to pay more, and you're trying to like time the market perfectly with that interest rate. And it could be that you have to overbid by $10,000 or $20,000, like we talked about. So now all of a sudden you're $560,000, $570,000, right? Then you have to start doing dumb things like shortening your inspection window, removing your appraisal contingency, and coming at cash out of pocket based on the appraisal.
Seller assist goes out the window pretty much.
Right.
I mean, because they know they can get full price or more.
Right.
Yeah. So a lot of things change for you.
Yeah.
Now's the best time to get that purchase and worry about the better finance, the better rate when that becomes available.
Yeah. What we're seeing right now, interesting too, in the market with 3.5 months of inventory, the lower price point is still moving. That entry home, first time, whatever it might be, that entry kind of level home. You can't give the middle away. We have homes that are sitting, 90, 120 days on the market in that 5 to 750, and then all of a sudden, like above $1 million, multiple offers. I'm like, I just can't figure it out, right? Like,
the homes over by us are just sitting. We live out in the ranches area in Cocoa, and they're like all acre to 5 acres, and all those homes are in that $500,000 to $700,000 range. They're all just sitting.
Right.
Now a lot of them need updates and stuff, I've noticed, but they're just sitting. So, whereas like a year ago, they were flying off in like 5 days.
Right.
So it is pretty crazy.
Yeah. Another thing that we offer, and some people are taking advantage of it, or at least considering it, is you can do this, 3-2-1 or 2-1 buy down, so that gives you, take the 2-1 buy down for example. I mean, the 3-2-1 is twice as much as the 2-1 because that's it. That third year in there is
substantial.
Yeah, exactly. But if you do the 2-1 buy down, that means over the next 2 years, if you've got a 7% interest rate, you're going to pay 5 the first year, 6 the second year, and by that third year, now you're going to pay the full 7%, right?
Right.
Well, we're also going to give you the 2-year no lender fee refi. So if any time during these 2 years where you're paying the less rate, the rates do drop, you take advantage of that as well.
Yeah.
And so there's a lot of people who are interested in that.
I don't see why you wouldn't be interested.
Yeah.
Like,
Yeah.
It's amazing to me that people still don't understand a 2-1. Like, we explained it on what feels like a daily basis to somebody, right? Like, take advantage of that. Something that, so I tend to be try to be a bit of a visionary and see where things are going, right? Like, how we solve the problem for a large class of people. And so I've been on this thing of trying to figure out, right? Like, how amazing would it be if a consumer had an app, right? Like, we'll call it the Home Prime account, right? Just to kind of get people to start thinking about it in more of an Amazon light. But I would have this app, and if my insurance rate came down, it would send me a notification. Like, I know that you're locked into this rate right now, but based on what we're seeing, more carriers are opening the market. This carrier actually has less dollars tied into this zip code, right? And all of a sudden you could save $100 a month. Push a button and make it happen. On the lending side, right? Like, your interest rate, just click down 0.25%. Click this button. Yeah, maybe you have to sign the actual contract that says, yes, you're agreeing to do this. But like, within 5 minutes, I could figure out, like, I'm waiting for the company to come on the scene that says, I'm going to make this beautiful thing. Oh, by the way, I'm going to put all these vendors. So that's why I call it the Amazon. Like, my AC just went out. Well, here's the top 5 AC vendors that we've trusted, vetted. They show up on time. They do what they say they're going to do. And from one app on my phone, I can control, like, hey, this was a good week. I saved $100 a month on insurance, and my rate clicked down. Like, do you see a world in which that happens?
Be cool if it did.
Yeah.
Florida's insurance is just too wild of a beast to ever do something like that. Just to give you an example, our company, Goosehead, is it's a large company nationwide, publicly traded. You can buy stock in Goosehead. They have a website that you can go on and request your own quote. And it will basically, any other state, the United States, will give you a pretty accurate rate and all your options with accurate rates. But the people in Florida can't get a rate to save their life on it because there's just too much information that goes into a rate in Florida with the wind mitigation, the build type, the roof shape, the location, whether it's frame or masonry. There's so much that affects that rate that the average consumer can't put that information in order for a computer system to actually do it. And you also have all these things you have to jump through in order to even give permission to get a rate. So the app would basically be, I guess you would sign up and agree to get permission to have your rate ran. Maybe if you could put all that information into the app, and then the app would be regularly looking for you.
Load my 4-point in, and
so yeah, I mean,
AI reads it, and
but then it's taking my job. So
I know.
I don't want
Trust
that.
me.
I don't want the AI taking my job. My job's never boring.
Look,
Yeah.
I don't think it replaces the human connection of.
Well, I mean, but people do
Hey, Jordan,
want,
is this rate really true? Like
Yeah.
that you just sent me? Yes, it is. Okay, great. Yeah,
as long as
thank
a human goes in and kind of finalizes it. But I just think that, and also explaining the different coverages, that's kind of missing from that. It's like, is the rate lower because my coverage is the same? It's like if you call Geico's like, oh yeah, we'll give you a lower rate, we'll lower, but they're lowering coverage.
Right.
So like they're not magically just coming up with a lower rate.
Right.
So it's just, I don't know. I think it's a great idea. I think it would kind of streamline things a little bit for people. If insurance was super simple and it was just a fire policy, great. But because there's right now, insurance companies offer so many different types of coverages that you can elect or not have, replacement cost on your contents versus not, that type of stuff.
Right.
People just don't really understand that, and they don't read it. They don't even read their applications most of the time. So I just think it'd be difficult to streamline it like that with all the different options that are available.
It just got me to ask another question. And sorry, Randy, I want to come to you. But is there a state that doesn't have multiple types of coverage? Right? Like I grew up in California. We had earthquake insurance, right? Which doesn't happen that often, right?
Yeah.
And yet now there's wildfires sweeping through.
Mm-hmm.
You know, you look at the middle. Like you can
Tornadoes.
have snow, flood, tornado, right? Like,
Yeah.
is there a state that
Yes, there is. That's what I was saying, that when you go to goosehead.com and you get your quote, pretty much every other state will give you a rate and it'll be accurate. Florida's just a whole other thing. Like I'm licensed in Georgia. Georgia policies are relatively easy to quote, relatively easy to write. You know, they get brushed by a hurricane every now and then. Tennessee's a little harder because they have floods. You know, they have a lot of those flash floods. The Midwest, they get the twisters and stuff like that. So I've never written a policy out there. I don't know. But every part of our country has its own type of catastrophic loss. The Northeast, they get the freezes or the pipes burst. California's got like every single thing you can imagine. They've got fires, they've got earthquakes, they've got hurricanes that hit sometimes,
Flooding.
Droughts.
Yep.
So
Mudslides.
such a great state, but they've got all these different things they have to insure for. And right now, the word on the town is they've got one carrier in the state of California open.
Yep.
And I think it's the state's insurance carrier.
Yeah, it's going to get really interesting there.
Yeah, so it's like we have it. It's not great here, but it's not California bad. So here we are.
Yeah. Where do you see the future of technology and home loans going?
Well, what's good about our app is our direct mortgage loans app allows people to go out and do hypotheticals even after their loan closes. Even people who may have applied with us and then they might have gone somewhere else, or they backed out and they're not even doing a loan anymore, or maybe their loan was 5 years ago, they still have access to our app, and they can go out there and they can do scenarios. Hey, if my rate came down to 7%, how much can I save, etc. They have that. What they do not get is they do not get an alert saying, hey, your interest rate is what you paid to what it is now is down. Now, I, as a loan officer, I get that. Once it hits about 0.75%, that's when we start getting those alerts saying, hey, Billy, Bob, Susie, Q, they're, rate that they closed here, their rate is now here, it might be an opportunity to reach out to them. The reason why you could not have, just like Jordan was saying, there's so many variables. The reason why in the lending industry you could not have that automatic variable is because there's so many things that go into the equation of whether or not they're qualified and what will their rate be. For example, I had somebody the other day that applied for a loan. Their total income a month is about $2,700. They went recently and bought a truck for $1,002. You pretty much have no money now, right. To be able to buy a house. For every $650 in today's market, for every $650 worth of debt you have, you've reduced your buying power by $100,000. So if you could have afforded a $400,000 house and you went and bought this truck prior to closing on the house, you can now only afford a $300,000 if that right. truck was $650.
Yeah.
Yep. In today's market, in a different market, that obviously changes. But so there's a couple things. First of all, I gave that example to say this: since they closed on this house, what kind of debt have they accrued?
Right.
Okay, because that debt might put them their DTI up above what's the maximum, where it's not a matter of they can't refinance for that rate; they won't even qualify. That's a possibility. Second item is: are they still with the same income source?
Job.
I switched job 2 months ago.
Yeah, exactly.
Why can't I get a refi?
Yeah, or I'm making less money now, or I took off for a while because I'm going back to school. There's lots of things like that happen, but not even a car, but other debts. All those things add up very quickly, and so your debt to your DTI, your loan to value, all those things come into play whether or not they're going to qualify. So that's the reason why you couldn't just press a button and say, okay, yeah, we're good. It might allow them to say, hey, I'm interested in pursuing. Can you do an evaluation for me? That right. could happen.
Right.
But there's too many things it's going to require human intervention.
They're tracking so much of our stuff. I would venture to say though too, like if I actually signed up for it, here's my entire bank. You can monitor my bank account 24/7, right? Like there's already apps that do that for spending right? Like trying to educate the consumer on where's your money actually going. But if I just plug that into my lender's app and I said, I'm an open box. You can see every time I go to 7-Eleven and buy beef jerky,
Yeah. That would be a hard no on that. Don't monitor me.
Don't monitor me, right? Well, I mean, it's just, it's amazing what is, what I believe we're going to see in the next 10 years is,
what we've seen in the last 10.
Right.
So,
this ability for these supercomputers and now AI, is very interesting. I've been waiting my whole life for this, by the way, because I was like math and science geek, and I was like, writing an email is torture. Now I just put it into AI and it spits out the email for me. And for those of us who would take 45 minutes to draft, like the average person, it's like, 5-10 minutes to draft a really long email. For me, I'm like an hour, like, does this even sound okay? Am I conveying what I want? In front of a camera or in front person to person, I'm great. But put me behind a computer screen, I'm like, oh, this takes me a lot. I have canned emails now, right? Like,
I am queen of the 2-sentence email. I'm like, here you go, straight to the point.
A friend of mine,
short and sweet.
A friend of mine posted yesterday. She said, my response to text or email is 37 seconds or 3 days.
Yeah.
You either get it in 37 seconds or I'm so busy that I will get back to you, but sometimes it'll take me 2 to 3 days. To wrap up, what do you guys specialize in? What makes you different? How can the consumer find you? All that kind of good stuff.
So what's different about us from the industry perspective is a lot of the insurance companies in the area will have like a one marketing person that goes out and they're the face of the company. And then all the leads that come in, you're basically don't know who you're working with, who your client's getting a quote from. You don't know any of that. With our company, everybody has their own partners. They go out, they do their own marketing, they do their own business relationship building. If you work with me, you get quotes from me. If you work with Jessica, you get quotes from Jessica. there is no situation where you don't know who your client's getting quotes from. And so what that leads to is I value my relationship with you, so I'm going to take very good care of the clients you send me. Whereas if you don't know who's sending you leads, you're just going to send out whatever is the quickest or whatever the situation is. So I just think our model makes us take better care of, because you're valuing two relationships at that point. So I think that's what kind of sets our team apart. And we're hiring. we're growing.
And you guys do not do commercial.
No.
You do home loan? What other type of insurance do you?
So we do home insurance, auto insurance, flood, umbrella, and then we partner with 2 life companies. So basically, we can send you a link, and you would just fill out, and it's all term, but you're doing it with that company, not with us.
Okay, fantastic.
Awesome. That's good. So I'd say what our specialty is that both Caleb and I are 24/7. There might be other people who say they are, but I mean, we truly are. I mean, it's nothing to get a text or a phone call at 8 or 9 o'clock on a Wednesday night, or a 9 a.m. on a Saturday or Sunday, and we're answering and processing the application, getting the pre-approvals. I personally go out to open houses all the time. I go out to them weekdays if there's enough out there, but especially Fridays and weekends, I try to go out and hit maybe 10 or 12 houses. Go out and make new relationships with realtors so that they know that you're a real person, and sit down and have coffee with them and see what are the things that I can do to help them and what they can do to help me, and build relationships. One of the things I tell those who are the buyers, the applicants who are out there shopping, is that have been pre-approved with us, is I'm there not just for the application. Some people will take application and they'll disappear. I'm going to be there for the duration. I probably go to about 85% of my closings. I'd like to be at those closings and help celebrate. A lot of times that's the first time you meet the buyer, because most everything is done online. If I have buyers that are older folks, or people who are might be technology challenged, or they just want to meet their loan officer in person, I have no problem going and going to a Starbucks or going to McDonald's and meeting them and getting their documents and making the copies and processing their loan for them to make it easy for them. So we jump through hoops, but even after the loan closes, I should say, call me if you have any questions, especially if you get junk in the mail that someone's trying to sell you something, buy something from them. Don't pay a penny for anything, because most of that's junk. If you have any question, you call me, because I'm there for you. I'll be there down the road, and if you have anyone that of that needs a loan, you send them to me, because you know how I've treated you, and I'll treat them the same way.
What percentage of your business is non-QM these days, out of curiosity?
Most is QM.
Okay.
But we of course do the conventional FHA, VA, USDA, all the conventional stuff. But we do bank statement loans. We do DSCR loans which is really good for those who are in the rental industry that want to put their loan and their deed in an LLC. We offer all those as well. Those non-QM are normally 20% down and slightly higher interest rates, but it takes away the tax returns and all that stuff. It's really like a DSCR loans based on 20% down payment. You have a good credit score, and the ratio is going to work out where it's going to be a profitable investment. You can get approved.
Jordan, are interest rates higher on investment loans?
Interest rates?
Or
not, insurance?
Insurance higher on investment properties?
It depends on if it's an annual renter or a short-term renter.
Okay.
Short-term insurance is very expensive. It's just a higher risk to carriers having a multitude of people in and out of the home. But no, I will say your options are limited, and you'll have, chances are, no liability coverage if you have an LLC owning the home, and we have to insure it through an LLC, but we do have supplemental products. We can write a secondary, liability-only policy for that type of thing. But yeah, the options are there. They're not necessarily higher, but they are for short-term, guaranteed.
Yeah. Well, hopefully in short term you're making more so that you can spend more in insurance.
It's a lot more. Like
It's a lot more.
it's like 2,000 for an annual renter and like 6, 7, 8 for a short term. You really have to be hustling.
Right.
But hopefully that again, the carriers will
Airbnb or
accommodate.
Yeah. Yeah, I'm not in. I tell people that all the time. That is not my world of real estate investing, and there's another reason why.
Yeah. I mean, I get it. And the argument is Airbnb has its own policy that they're already paying for, and they're going to use that anyways. But those two industries don't talk. So someone needs to get them working together because, I mean, I think the average Joe should be able to own 6 or 7 homes. There's no reason that, the hotels and the hedge funds, there's no reason they should be the only ones raking in rental money.
Right.
Do I think they should continue to? Sure. But I think if we can have 6 or 7 homes, as assets and be able to short-term rent them, I think that opportunity should be there. But right now, insurance in Florida, they don't like it. They just don't. I'm hoping it'll change. We're starting to see more carriers open up to it. They're testing the waters. So.
Yeah.
Yeah.
As long as nothing catastrophic happens in the Airbnb world, right?
Yeah, nothing. Yeah, that definitely it's an interesting thing that they have there. So
Yeah. Awesome. Thank you both so much.
Thank you.
It's been fun.
yeah, I've had fun. This has been fun.
Thank you so much.